Hello again, and thank you for joining us. This is Robert Schein, Managing Director, Partner, Blanke, Schein Wealth Management. Today is May 21st. It's a Tuesday of 2024, and we're going to talk about three things markets are paying attention to. Markets have been moving, so you should be paying attention as well. So thanks for watching, and let's get right to it. We're going to talk about the estimated revenue growth of the S&P 500. Markets have hit highs this year. In fact, last Friday we had 40,000 the Dow Jones Industrial Average, which is sort of a head scratcher in the sense where no one predicted this year, given all the rate hikes and the economy, to have the markets hang in there. And ultimately, what holds markets in there are the earnings. And so far, earnings, again, last earnings report or quarter, we've had plus 80% of those of the S&P 500 that have met or exceeded expectations. And guidance wasn't too shabby moving forward. In fact, we're seeing an earnings acceleration of growth estimates for the next 4 quarters, as well as going into 2025 of above 5%. In fact, the 2025 estimates on the S&P has a collective growth rate of 14%, which is just head scratching. We're going to show you a slide, and that slide is going to talk about the annual earnings per share approaching $280 a share, essentially, for the earnings estimate. So that number, earnings per share, takes all the collective earnings of the S&P 500. Last year, if you recall, we were about 225, 220. Right now, 244 is the estimate between now and year end. And keep in mind, they always start off high and then they start dwindling their way down. But year over year, we're still seeing growth. And that's the whole idea of why markets are in there. Now, obviously, we have some different things to consider, consumer sentiment, as well as how the consumer is being sensitive and digesting some of this inflationary pressures. And we're seeing businesses, big time retailers, that are now reducing and slashing prices to incentivize consumer demand, continue the consumer to come out and spend, or maintain a sort of a value proposition to indicate that they're going to help the consumer where the consumer needs to be. Again, 2/3 of the U.S. economy, as measured by the U.S. GDP, is consumer driven. So we're paying very close attention to how companies react relative to what they need to do to get those sales. Again, companies have several levers, if you will, that they can do. And oftentimes you're seeing big companies cut and slash their workforce. That's the easiest and quickest way to add make certain that top line revenue makes it all the way down to your operating bottom line revenue to maintain your margins. And so that's one of the ways. Another way is to incentivize the growth of sales by lowering the price of the goods or services that you're seeing. All in well, it's going to sort of help if they bring down those prices for the consumer, as we need the consumer to continue to hang in there. But we're seeing some price acceleration or some growth acceleration in earnings, which is huge. And the only thing I'm going to talk about, again, we also have housing inflation in today's updated talk. Housing inflation, after the Fed's pivot in last November of 2023, lower mortgage rates, rising stock prices, and increased activity in the capital markets have put upward pressure on rents in Manhattan. And it's easy to see. So we're seeing sort of a rebound in rents. Again, Federal Reserve needs to see wages come down. We see the JOLTS gap, so the job openings slow down. And so more people have less of an opportunity. Again, we are about 3 million shy of what we need in the U.S. economy right now to maintain sort of an equilibrium or balance of sort of job openings to relative to ready and available workers right now. But that is trending towards each other and closing the gap, and that's going to help inflation. That's what the Federal Reserve is looking for. And the last piece is the inflationary housing, sort of affordability of your home. So if mortgage prices are still up, or mortgage yields, as well as housing prices are up, that's going to be a tough time for the Federal Reserve. Hopefully we're going to see a trend sort of reverse. That's what the Fed needs, and that's what we're going to be paying attention to. And so tomorrow we have a special treat. We have CNBC filming from our Palm Desert office here, Blanke, Schein Wealth Management. I'm featured on a panel for the CNBC Financial Advisor Investors Summit. Now, this is a pay for participation, so I don't expect clients to log in and pay for this. But I do want to let you know that we're going to be participating. I'm going to be interviewed by Brian Sullivan on a panel, and it's going to be pretty exciting. So we're going to do our best after the fact to get you that video footage of that conversation. I am weighing in on the energy sector, so it should be interesting of what we think energy will be playing out for the rest of the summer. Well, one thing's for certain, as I see CNBC right now, Biden just went out there and said, hey, he's going to release 1 million barrels to bring down oil or gas prices at the pump in anticipation of lowering basically oil or gas prices right before the July 4th holiday. That's not strategic. I don't know what is, but we can talk more about that tomorrow, and then later this week we'll get you that information. But it's kind of an exciting announcement. They'll have a crew here, and we'll go from there. So that's our update for today. Thanks for watching, and we'll see you next time.